Imagine you wake up, right? And it's January 1st, 2026.
Okay, setting the scene.
Yeah. So you roll out of bed, you check your accounts, and you have like exactly $0 in assets.
Oof. Just nothing.
Literally nothing. No stocks, no bonds, uh, no safety net. And maybe you even have a little bit of consumer debt hanging over your head, too.
Which is incredibly common, honestly.
Right. And to make matters worse, you open your phone and the headlines are just relentless. I mean, they're screaming about volatile interest rates, AI making entire industries obsolete practically overnight.
Oh, yeah, the AI panic is everywhere.
Everywhere. And housing prices that look like, phone numbers with area codes attached.
Yeah, the standard advice you've been hearing for a decade, like just stop buying $4 latte, it just feels like a really bad joke in this economy.
Totally. It feels completely tone deaf.
It's a landscape that genuinely induces paralysis, you know? When people look at that kind of economic pressure, the default reaction is to assume the entire system is just rigged against them.
Which, I mean, is a fair feeling to have.
Right. They feel like they're starting a marathon 50 miles behind the starting line, so they don't even bother lacing up their shoes.
Which makes complete sense psychologically. But that is exactly why we are jumping into this specific source material today for our deep dive.
Absolutely.
We have a playbook here that is tailored specifically for you, the listener. Whether you're staring down that exact $0 scenario right now, or, maybe you just feel like you're redlining your engine but stuck in financial neutral.
Yeah, spinning your wheels.
Exactly. The mission today is to extract the exact mathematical roadmap from this source that takes you from absolute zero to your first $100,000 and eventually to $1 million.
But we should probably set expectations right away. Right?
Yes, definitely. To be crystal clear, this is not a get-rich-by-Tuesday scheme.
No, far from it. It's a get wealthy for sure strategy that's really built for the realities of our current decade.
Right.
And what really stands out to me in this material is how it refuses to treat us like perfectly rational calculators.
Oh, totally, because we aren't.
Right. It perfectly synthesizes the incredibly harsh mathematical truths of compounding with the, well, very messy reality of human behavior.
It accepts that we're emotional creatures, right?
Yeah.
Operating in a highly unpredictable environment.
Exactly.
Okay, let's unpack this, because before we can build the penthouse, we really have to stop the foundation from sinking.
Yeah, you can't skip the unsexy stuff.
Right. Everyone wants to skip to the fun part, right? Opening a brokerage app, buying stocks, seeing the green numbers. But the source starts with a pretty harsh reality check about what it calls the negative compounding trap.
The debt trap.
Yeah, we have to talk about debt.
Yeah.
Specifically, this pervasive myth that you can somehow outinvest your bad financial habits.
Oh, man, you see this everywhere right now.
You really do. People are just desperate to buy into the latest tech ETF, which is an exchange-traded fund, basically just a basket of stocks you can buy all at once.
Right.
They want to buy that while they're simultaneously sitting on thousands of dollars of credit card debt.
It's a very common trap.
Yeah.
Because buying an asset, it feels like forward momentum, you know? It feels like you're doing the right thing.
Yeah, you feel like an investor.
Right. But mathematically, you're just working entirely against yourself.
It reminds me of trying to walk up a down escalator. I mean, you're putting in an incredible amount of effort just to go absolutely backwards.
Well, that's a great way to picture it.
But I'll admit, there is a friction point here.
Yeah.
I want to push back a little, or at least play devil's advocate.
Sure.
Why not try to do both at the same time?
Yeah.
I mean, if I genuinely believe the stock market will get me an average return of, say, 10% this year,
Okay.
why shouldn't I slowly pay off my 24% credit card debt while simultaneously building up my investment portfolio?
Well, it sounds reasonable, right? Until you actually look at the mechanics of risk. Paying off a 24% credit card is a guaranteed 24% return on your money.
Guaranteed.
Yeah.
Guaranteed. The exact moment you pay it, you instantly stop that negative compounding. You absolutely cannot find a guaranteed 24% return in the stock market.
Nowhere.
Nowhere. Achieving that kind of upside requires taking on catastrophic risk that could, completely wipe out your principal.
Right. You could lose everything.
Exactly. Your feelings will tell you that you're building wealth by buying those stocks, but the math shows you are just bleeding out.
And Source breaks down the math on this beautifully. Like, if you have $5,000 in consumer debt at a 24% interest rate.
Which is pretty standard for a credit card, sadly.
Yeah, very standard. And you only make the minimum monthly payments, you are going to end up paying back nearly double that amount over the next decade.
It's brutal.
It is. Every single dollar of interest you hand over to a bank is a dollar that isn't compounding for your own future. You're essentially financing the bank's wealth instead of your own.
And, beyond the raw math, the psychological cost might actually be heavier.
Yeah. Well, we tend to keep this debt around because we normalize it. We view it as just another monthly line item, right?
Yeah.
Sitting right there next to the streaming subscriptions and the utility bill.
Yeah, just the cost of living.
Exactly. But having that liability quietly running in the background, it forces you into a scarcity mindset.
I can completely validate that.
Mhm.
I mean, years ago, I carried a balance of about $3,000 on a card for entirely too long.
A lot of people do.
Yeah, and I told myself it was manageable, right? But there was this low-level hum of anxiety underneath every single financial decision I made. I just felt tethered. You really don't realize how much it dictates your behavior until it's finally gone.
That tethering is exactly the danger. When you owe the bank, your tolerance for taking calculated life risks just plummets.
Oh, for sure.
You might hesitate to ask for a raise because you feel you can't afford to rock the boat. Or you might turn down a chance to move cities for a better opportunity because the transition feels, too precarious.
Right, the stakes feel too high.
Exactly. The true cost of that 24% debt is the opportunity cost of the life you're too cautious to actually live.
That's a huge point. So clearing this isn't just about balancing a spreadsheet. It's a massive psychological unlock.
Huge.
And to execute this, the source lays out a protocol called the avalanche method.
Yes, very specific instructions here.
Right, so you list every single liability you have, and you rank them entirely by the interest rate, from highest to lowest.
Ignore the total balance size, right?
Yes, completely ignore whether it's a huge loan or a small one. Just look at the rate. Then you treat that highest rate debt like an absolute hair-on-fire emergency.
Your house is burning down.
Exactly. You throw every spare dollar at it, sell things you don't use, while just paying the bare minimums on the lower rate debts. You essentially stop being a consumer, and you become a debt destroyer until that high-interest line item is gone.
It demands an intense, single-minded focus.
It does. So let's say we do that. The escalator is finally going up. The high-interest debt is completely eradicated. Yeah. And the immediate impulse is to sprint directly to the stock market, right?
Yeah.
To start making up for lost time.
Naturally.
But the source throws up a massive stop sign here. It warns against what it calls the emergency trap, arguing that if you skip this next step, you are statistically likely to fail as an investor within 18 months.
And this is where we run into the cash drag illusion.
Right. Explain that.
Well, if you spend any time listening to financial influencers online, you'll hear this constant mantra that cash is trash.
Oh, all the time.
Right. The argument is that inflation is constantly eroding the purchasing power of your dollars, so you need to be fully invested 100% of the time just to outpace it.
Which, technically makes sense on paper. Inflation is a real threat.
It is. But what's fascinating here is how the source deliberately redefines the purpose of cash in these early stages of wealth building.
Okay.
In this specific phase, your cash isn't an investment designed to beat inflation. It is insurance against life.
Oh, I love that reframe. It changes the entire strategy. You aren't looking for a yield, you're looking for a buffer.
Let's look at the tale of two investors from the text to see why this is mechanically vital.
Yeah, let's walk through it.
Imagine investor A and investor B. Investor A listens to the influencers, believes cash is a liability, and puts every single spare dollar they have straight into the stock market.
Right, going all in.
Exactly. Now, investor B, following the source's roadmap, keeps $10,000 in a high-yield savings account, which is really just a bank account that actually pays you a decent interest rate, say around 4% right now.
Or they use a money market fund, which is a super low-risk mutual fund that basically just holds short-term government debt.
Exactly.
Either way, investor B has $10,000 that is completely liquid and completely safe.
Right. Now, suddenly, the market corrects by 20%.
Which happens.
It's historically normal. It happens every few years, but right as the market drops, both of our investors lose their jobs. Or maybe they face a sudden medical emergency. Life just happens.
So investor A is caught completely exposed. They need to buy groceries or fix their car, but their bank account is totally empty.
Yeah.
So they are forced to sell their stocks while the market is down 20% just to survive.
Exactly. They just permanently locked in a massive loss.
And destroyed the very compounding engine they were trying to build in the first place.
But investor B has a completely different experience.
Because investor B has that $10,000 buffer. so they don't even have to look at their stock portfolio.
No need to log in.
Right. They pay for their groceries and their rent straight out of the savings account. They get to sleep soundly, while investor A is absolutely panicking.
And when the market inevitably recovers, investor B's portfolio bounces back completely intact.
The math always favors the person who is never forced to sell at the wrong time.
Always.
It acts exactly like a shock absorber on a car. I mean, you are still going to hit potholes, right? The transmission gives out, or you need an unexpected root canal.
Life's potholes, yeah.
Yeah, but the shock absorber stops the impact from destroying the actual chassis of the car. It creates a physical and psychological gap between a crisis and your response to it.
That's spot on.
So when the market crashes and you have that cash moat, you look at your portfolio's red numbers and you see stocks on sale rather than a personal catastrophe.
It fundamentally strips the emotion out of financial decisions. And panic selling and FOMO buying, fear of missing out, those are the two behaviors that will absolutely bankrupt you.
So true. And the protocol to build this shock absorber is highly specific in the source.
Yeah, walk us through it.
You calculate your bare bones survival number. So not your lifestyle number with the restaurants and the vacations, but just rent, food, utilities, and minimum transport.
The bare minimum.
Exactly. Multiply that by 3. That is your 3-month fortress. You automate transfers into that high-yield savings account every payday until it hits the target.
And once it's full?
You pretend it doesn't exist. It is strictly for survival.
So with that cash moat built, we finally get to transition from defense to offense.
Which brings us to the engine itself, investing. You have zero high-interest debt. You have a cash buffer. Now you finally actually open the brokerage app.
The fun part.
But here's where it gets really interesting. The source actively warns against exactly what most modern financial platforms prompt you to do the absolute second you log in.
Conventional wisdom, and frankly a lot of algorithmic nudging, says that the moment you have an extra $500 a month, you need to diversify broadly.
Right. Buy a little crypto, pick some emerging tech stocks, maybe some gold, just sprinkle it all around.
But the material argues that over-diversification at the very start of your journey actually guarantees mediocrity.
Wow.
Yeah, you actually need concentration to build wealth initially, and then you use diversification to preserve it later. It directly attacks this illusion that you can pick winning stocks.
Especially right now. I mean, we are constantly tempted to use new AI screening tools or listen to internet analysts trying to find the next NVIDIA before it pops.
Because everyone wants to be the one holding the winning lottery ticket. We all want to be the genius who, saw the future.
Exactly.
But the data tells an incredibly sobering story here. The source references the SPVO scorecard.
It's BV.
Right, which is basically the gold standard for tracking how active professional fund managers perform against a simple, automated S&P 500 index fund.
The pros versus the robots, basically.
Exactly. And over a 15-year period, more than 90% of active fund managers fail to beat the index.
Like 90%.
Over 90%.
That is, I mean, if we really think about the mechanics of why that happens, it's wild. These professionals charge a 1% or 2% management fee just for existing.
Yep, win or lose.
Right. And in a market that's dominated by hyper-efficient algorithmic trading, their quote-unquote expert guesses are usually just too slow or flat-out wrong. Right. And those fees eat whatever tiny edge they thought they had.
If we connect this to the bigger picture, these professionals have Bloomberg terminals on their desks. They have armies of analysts under them. They do this 80 hours a week.
Right.
And 90% of them still lose to a dumb automated index fund. So the odds of a retail investor picking the right individual stock on their phone during their lunch break, it is statistically zero.
It's a massive reality check. You don't need to be smart enough to pick the winners. You just need to be smart enough to avoid picking the losers.
Perfectly said.
If you just buy the entire haystack, like a total stock market index fund, you are guaranteed the average market return. An average in the stock market historically hovers around 10% before inflation, which makes you incredibly wealthy over time.
But there is a huge behavioral hurdle here.
Oh, because it's painfully boring.
It is so boring.
Good investing should literally feel like watching paint dry. You buy a broad market fund and nothing happens. There are no dramatic earnings calls. There are no rocket ship emojis on your timeline.
None of that.
And as humans, we crave action. We want a dopamine hit. We want to feel like our active involvement is what's generating the wealth.
That's exactly why people day trade. They are taking on catastrophic risk just to feel involved in the process.
Which is why the source offers a very pragmatic compromise, right? The core satellite approach.
I love this approach.
It acknowledges our neurological need for dopamine, but it builds a containment unit for it.
Right, it's a safety box.
Exactly. So you put 90% of your investable cash into those boring, low-cost, broad market index funds, total U.S., total international. That is the core. You automate it and you never ever touch it.
Set it and forget it.
Yes. But then you take the remaining 10% and strictly capped at 10%, mind you, and you let yourself be completely speculative with it.
That's the satellite.
Right. You buy that single AI stock, you buy the crypto, whatever, you use it to scratch the itch. If it goes to zero, your overall financial plan is completely fine. If it goes to the moon, fantastic.
It's a brilliant hack for human nature. You get the thrill without actually risking ruin.
Okay, so we've automated this compounding engine. It's finally making money. But now there's a new predator in the water, the IRS.
Oh, yes. Taxes.
How do we stop taxes from quietly draining the wealth we just built? Because if you put those perfect index funds into the wrong type of account, you are essentially driving with the parking brake on.
We focus so obsessively on the returns, right? Like what percentage our portfolio is up, that we completely ignore the net result.
Exactly.
It's not just about what assets you select, it's about asset location. Where does your money actually live legally?
Why are the standard frictionless brokerage apps so dangerous for this specifically?
Because standard taxable brokerage accounts offer zero tax shelter. Every time you sell an asset for a profit, you are hit with capital gains tax.
Which is a tax you owe specifically on the profit of an investment.
Right, and every dividend you receive gets taxed that year too. The source breaks down the math of this, and they call it the $18,000 mistake.
Oh, let's definitely walk through the mechanics of that mistake.
Okay, say you invest $10,000. Over 30 years, it grows to $100,000.
Nice.
Yeah, great return. But if you grew that money in a standard taxable account, when you finally go to withdraw that $90,000 of profit, you might owe 15% or 20% in capital gains taxes to the IRS.
Wow.
That is $18,000 of your wealth just completely gone.
Oof.
But if you had grown that exact same money inside a Roth IRA, that withdrawal is 100% tax-free. You keep the entire $100,000.
It's wild that a simple administrative choice of where to house the money outweighs years of actual investment strategy.
It really does.
But I know the immediate pushback we're going to hear here. People hate the idea of locking their money up in retirement accounts until they're 59 and a half. What if someone wants to retire early or, an incredible business opportunity comes up?
That desire for liquidity is exactly what causes people to abandon tax advantages.
Right.
But the source reframes this brilliantly. Locking your money away in these accounts isn't a punishment. It's a feature that actively protects you from yourself.
Ah, so it acts as a behavioral guardrail.
Precisely. The early withdrawal penalty isn't just the IRS being difficult. It's a structural barrier that prevents you from raiding your own future to fund a short-term impulse.
Like a new car or a lavish wedding.
Exactly. It forces commitment to the compounding process. And, we haven't even mentioned the employer 401k match yet.
Oh, free money.
Literally.
Yeah.
If your company offers a match, that is a 100% immediate return on your money. There is nowhere else in finance you can beat that math.
And to navigate all this, the source outlines a protocol called the waterfall. You fill these tax advantage buckets in a very specific order.
Walk us through the waterfall.
Step 1, you contribute to your 401k only up to the employer match. You take the free money, then you stop.
Makes sense.
Step 2, you max out a Roth IRA because you fund it with post-tax money, meaning it grows tax-free forever, like we just talked about.
Yep.
Step 3, if you qualify for a high-deductible health plan, you max out an HSA, a health savings account. The mechanics of the HSA are just incredible. The money goes in tax-free, it grows tax-free, and if you use it for qualified medical expenses, it comes out tax-free.
Triple tax advantaged. It's the only account that legally bypasses taxes at all 3 stages.
That's amazing. Then step 4, if you still have money left to invest, you go back to the 401k and fill up the rest of your annual limit. Only after all those buckets are overflowing do you finally open a standard taxable brokerage account.
It essentially creates an impenetrable tax shield around your compounding engine.
Right. So we've got the defense dialed in, we've killed the debt, built the moat, automated the engine, and shielded it from the IRS.
We're looking good.
But the source brings up a ceiling we haven't discussed yet. breaking your income limit.
Because there is a hard mathematical floor on cutting your expenses, but absolutely no ceiling on your earning potential.
This completely dismantles the frugality trap. We mentioned it at the top, right?
Right.
The idea that skipping lattes makes you rich.
Yeah, the latte effect.
The latte effect is garbage if you are making a $30,000 salary in 2026.
Yeah.
You cannot budget your way to wealth when the cost of living is constantly rising.
It's physically impossible.
Right. Focusing 100% of your energy on extreme budgeting is playing pure defense. Defense prevents you from losing, but offense is how you actually win the game.
And playing offense requires understanding the critical difference between linear income and leverage.
Linear versus leverage.
Exactly. The source compares taking on a typical side hustle to acquiring a high leverage skill.
Right, so if you drive for a rideshare app on the weekends, maybe you net $20 an hour. That is purely linear income.
Time for money.
The literal second you turn off the car, you stop getting paid.
Mm.
But if you invest that exact same amount of time into learning a high leverage skill, everything changes.
Exactly. In 2026, a high leverage skill might look like transitioning from manual data entry to learning how to build automated data pipelines, or mastering AI prompt engineering for content creation, or learning specialized B2B sales software.
Something scalable.
Right. Acquiring just one of those skills can net you a $20,000 to $30,000 recurring bump in your primary salary.
And the beauty of that bump is that it compounds too. It increases the size of your 401k matches, and it sets a permanently higher baseline for all future raises.
It's exponential.
A 20% savings rate on a $100,000 income is astronomically more powerful than a 20% savings rate on $50,000. It makes every single other step we've talked about work 10 times faster.
But we do have to acknowledge the psychology here too, right?
Always.
Learning complex new things is grueling. It is far easier to just drive a car for a few extra hours on a Sunday than it is to sit down and struggle through a coding certification or a really complex software tutorial.
Yeah, nobody wants to feel dumb.
Exactly. We naturally gravitate toward low friction income. But low friction means a low barrier to entry, which inherently guarantees low pay.
So what does this all mean? It means you have to actively embrace the discomfort of being a beginner again. You have to be willing to feel incompetent while you learn the new skill, because the comfort zone is exactly where financial dreams go to stagnate.
Beautifully said.
The protocol for this is the skill audit. You look at your current industry and identify one specific capability that, if you mastered it, would make you absolutely undeniable to an employer.
Undeniable. I like that.
Then, you dedicate exactly 1 hour a day to it. The source suggests taking the hour you currently spend scrolling short-form video on your phone and redirecting it to free online courses or tutorials. You do that consistently for 6 months, and then you leverage that new capability to demand a raise or secure a higher-tier role. You must increase the size of your shovel.
It creates a complete closed-loop system for wealth generation.
It really does. So let's seamlessly recap this roadmap for you. You kill the high-interest debt using the avalanche method to stop negative compounding.
Yep.
You build a 3-month bare-bones cash fortress in a high-yield account so you never have to panic sell.
Crucial step.
You deploy the tax waterfall match, Roth, HSA, then the rest of the 401k. You invest 90% of your money into boring, broad market index funds to guarantee the market return. And finally, you relentlessly audit and upgrade your primary skill set to break your income ceiling.
This raises an important question, though.
Oh, I'm listening.
The material frames this entire roadmap around reaching a destination, right? That first $100,000 or that first million in your spreadsheet.
Right, the financial goal.
But if you actually execute these steps, think about what is required of you internally. You have to conquer your impulsive spending habits. You have to build immense emotional regulation to withstand 20% market crashes without panicking.
Wow.
You have to delay gratification for decades, and you have to force yourself through the deep discomfort of learning complex new skills.
You are systematically rewiring how your brain processes risk, reward, and effort.
Exactly. You fundamentally shift from being someone who consumes low-friction entertainment to someone who produces high-leverage value in the world.
That's deep.
What if the true wealth you gain from this roadmap isn't actually the digits in the bank account? What if the real wealth is the total transformation of your identity?
Right.
Making that final $1 million not just a target you hit, but the inevitable byproduct of the completely new person you've had to become to get there.
That is a phenomenal shift in perspective. It's not just about what the math does for you, it's about who the math forces you to be.
Exactly.
Well, thank you for joining us on this deep dive today.